Hello everyone. Welcome to Sam's Summaries. This episode is a deep dive discussion into Sam Fury's summary of Chapter 8 from the book How to Make Money in Stocks by William O'Neill. It has been created with the help of AI. The chapter is titled Institutional Sponsorship. You can read the original post at samfury.com.
Ever try to predict where the stock market is going to go? Like try and guess which way a million birds are going to fly all at once? But what if I told you that there's a way to at least get a clue?
Okay.
It's all about this thing called institutional sponsorship. Have you heard of that before?
Yes, institutional sponsorship is something that a lot of seasoned investors watch very closely.
Why is that?
Because these institutions have a ton of money and really have the power to move markets. We're talking mutual funds, pension funds, hedge funds, massive portfolios. And when they decide to buy or sell something, it can really make a difference.
Interesting. So I guess to start off, why don't we just talk about the very basics? What is it about these institutional investors that makes them so important to understand?
Well, it really boils down to a simple economic principle. Demand drives prices.
Okay.
More buyers than sellers, prices go up. And that applies to anything, stocks included.
Right, of course.
So when you have these big institutions with their massive buying power, they become a major force in that demand equation.
Got it.
Their decisions can literally shift the balance, tip the scales, and cause a stock's price to move.
So how does this translate into actually picking stocks that are going to do well?
Well, that's what O'Neill really gets into in this chapter. He argues that looking at the presence and the behavior of institutional investors can give you some really valuable signals about a stock's potential.
Okay.
For example, he points to the rise of this company called Syntex back in the 1950s. They were a pharmaceutical company, and as more and more institutions started to recognize their potential, their buying activity drove the stock price up dramatically. It was a classic example of institutional sponsorship really fueling growth.
Okay, so you want to find the stocks that are attracting these institutional investors.
Absolutely. It's almost like a seal of approval. These are the experts. They're doing their due diligence. They have analysts poring over data. So if they're buying into a stock, it's a good sign that there's something worthwhile there.
Okay.
But here's where it gets interesting. O'Neill also cautions against blindly following the herd.
Interesting.
He says that too much of a good thing, in this case institutional ownership, can actually be detrimental.
Wait, so you're saying that you don't want a stock to be backed by a ton of these big institutions?
To a point, yes. You have to strike a balance. Imagine a stock where a huge percentage is already owned by institutions.
Okay.
And then some unexpected bad news comes out. What happens?
People sell.
Yeah. Suddenly all those institutions, they might start selling en masse to protect their investments.
Oh.
And that can lead to a really rapid price drop.
Interesting.
It's kind of like a crowded theater, right? Someone yells fire, everybody rushes for the exits all at the same time. Things can get chaotic pretty quickly.
Right, yeah. Makes sense. So how do you strike that balance then? How do you find the stocks with like the growing institutional sponsorship, but avoid those ones that are maybe already overowned? What's that sweet spot?
O'Neill's advice is to look for stocks that have at least a few institutional sponsors, not just one, but a handful, and ideally ones with a solid track record. Look for those institutions that have a history of making successful picks.
So it's not just about the quantity of the institutions, but also the quality.
Some are better at this game than others.
Right.
And to help with that, O'Neill suggests using resources like Investors Business Daily, IBD. They actually provide ratings of how well different funds have performed over time. You can actually look up a fund, see their 36-month performance rating, and get a sense of their track record.
That's cool. I also remember him mentioning checking out Morningstar.com.
Yes.
What is it about that website that makes it so valuable?
Morningstar is great because it lets you go beyond just the performance ratings. You can really see the top holdings of any mutual fund.
Oh, wow.
So it's like getting a sneak peek behind the curtain. You can see what they're buying, get a feel for their investment style. Are they focused on growth stocks or are they more into value stocks? Maybe they have a particular sector they really like. This can help you assess whether their approach aligns with your own investment goals.
Got it. So we've talked about finding stocks with the right level of institutional sponsorship. But O'Neill also has this whole thing about avoiding the favorite 50. These are basically the stocks that are already widely owned by institutions. Why does he say to stay away from those?
Well, think of it this way. If everybody and their brother is already invested in something, a lot of that potential growth might already be priced in. It's like trying to discover gold in a mine that's already been heavily excavated.
Yeah.
The chances of finding a big nugget are slim, right? Plus, these super popular stocks, they tend to be more volatile. They can swing wildly with any news or market shift.
Why is that?
Because everyone's reacting at the same time. It amplifies both the ups and downs. So yeah, you might see some big gains, but you could also see some pretty steep losses if things turn south.
Okay. So it seems like what we're saying is it's about looking for those kind of like hidden gems, those stocks with strong fundamentals, increasing institutional interest, but haven't quite become household names yet.
Exactly.
It's like finding an up-and-coming artist before they become a global superstar. You get in early and maybe ride that wave of success.
Right. And the beauty of using institutional sponsorship as a signal is that it's like tapping into the collective wisdom of these really smart, experienced investors.
Okay, so to recap, we've learned that following this smart money through institutional sponsorship can be a really valuable strategy. But it's crucial to understand all the nuances, right?
Yeah.
Finding that sweet spot of growing ownership, but not too much. Evaluating the quality of the institutions that are involved, and definitely avoiding those pitfalls of those over-owned stocks.
Precisely. And don't forget that institutional sponsorship is just one piece of the puzzle.
Right.
You still need to consider other factors, like the company's earnings, what's happening in their industry, the overall market conditions. You need all those pieces for comprehensive analysis.
Thanks for tuning in to Sam's Summaries. If you found this episode useful, let us know with a like, follow, and share. Also, if you haven't already, be sure to visit samfury.com to get free access to all of Sam's original summaries. You can also get any of Sam's books and other exclusive content. It's all completely free at samfury.com.